Investors Chronicle.
Hello and a very warm welcome back to the IC Interviews. I'm Dave Baxter, and today I am very pleased to be joined by Anthony Cross, one of the managers of the Liontrust Special Situations Fund. This is a name that may well be already familiar to you. It's one of the biggest names in the sector among UK equity funds and among the best performers from that sector over the last 10 years or so. It's been driven by a focus on quality companies and also a decent tilt to the small and mid-cap sector of the market. More recently, of course, like some other of many people's favourite funds, it has been one of the names to be harder hit by the sell-off. It's had quite a rough 2022 and also been hit by some outflows as investors worry about the impacts of inflation and of the rising rates environment. So, Anthony, thank you for joining. Very topical time, of course, still, unfortunately, to be speaking about markets. You know, you've seen many different conditions. You've worked on this fund since it launched in 2005, I believe. And now a lot of your kind of discussions in fund updates has been about fundamentals of companies. You know, are they holding up even as many of their share prices have been plummeting until at least very recently? To kick off, I'd be interested to hear where have you seen perhaps surprise resilience, and also where have you maybe had reason to have some concerns? Are there any areas where you have thought perhaps it's holding up slightly less than we might have expected?
Brilliant. Great question. So where have we seen resilience? Well, there's two aspects to resilience. One is obviously share price resilience, and the other one is earnings resilience. I'm pleased to say that on the earnings resilience front, the style, the process has really helped with the resilience of earnings. So you'll recall that we're looking for intellectual capital, intangible assets in businesses that we think provide very strong barriers to competition. So a strength of either intellectual property or distribution power or high recurring income. We're also looking for companies of high returns on invested capital, so cash flow returns on invested capital. So the types of companies we own have generally been businesses that have got some earnings resilience behind them. They are what we would describe as quality businesses, often with a nice growth aspect to them. So far, what we've been finding with our earnings of our companies is that they've been holding up well. They tend to be in sectors often with structural growth behind them. They tend not to be overly cyclical. So lots of companies in areas like engineering or media businesses, pharmaceutical companies, software companies of high contracted recurring income, some of the fee-based financials, the big consumer goods companies. So the resilience has been there on the earnings front. The share prices, though, of a number of companies have been under pressure, particularly at the beginning of the year, when there was that definite switch from quality and growth type businesses into value companies. And that was particularly pertinent in January and February time, that big switch went on. So we see the share prices of a lot of our companies come down, particularly at the beginning of the year. But so far, pretty good resilience on the earnings front. Many of our companies have been meeting or beating expectations. As time has gone on, clearly people are more worried now about recession. Economic growth has come down in terms of forecasts, and there has been a recessionary feel, definitely in areas very closely aligned with the consumer. So companies often that we won't be owning in areas like retailing or in areas like sort of leisure or restaurants have definitely been having profit warnings in the UK, but so far we've escaped that. Where we have seen more recently a little bit more of a concern about economic growth and some downgrades to future numbers are companies like Savills in property and Michael Page in recruitment. So some of the more cyclical elements of our portfolio have just started to see a little bit more of a foot on the brake in terms of future forecast earnings coming through. So that's the flavour of where we've been at year to date.
It's interesting you mentioned PageGroup, and I believe as of the end of last year, you also had Robert Walters. It'd be interesting to expand on that point. Do you think kind of employment will hold up better in this recession than previous ones? We've seen kind of a very early warning sign from PageGroup fairly recently. What's your feeling on that?
Yeah, I mean, it's very difficult to know where we might be going with regards
Mm.
to economic growth. Clearly, there is a slowdown. Some people think there'll be a recession. Some people think there'll be a deep recession. Some people think there'll be a light recession. And what we deliberately don't do as a style is try and do great economic forecasting. So our overall footprint is quality growth. We tend to have more dependable businesses than the stock market as a whole. So cyclicality in the fund is what we would describe as our quality cyclicals. So companies like PageGroup or Savills or Robert Walters that can continue to invest in the downturn and then hopefully come out more strongly into the next upturn. And we have engineering companies like Renishaw that do that too.
Mm.
So with PageGroup, what is going to happen to employment is difficult to tell. One of the great things that the company and Robert Walters too have is that compared with previous downturns, they've just become more and more international. So your spread of earnings around the globe is much bigger than it would have been 10, 20 years ago. So the recessions for these companies have a different impact. They tend to be more regional in terms of their impact rather than overall clobbering the companies. So you might have a downturn in the UK, you might have a downturn in Europe, but there'll be other parts of the world that are holding up better for them. And as I say, they should go on investing during that downturn. There seems to be at the moment, employment rates seem to be holding up quite well. What's happening at the moment in terms of why PageGroup have had a downgrade is that there just seems to be companies are taking a longer time to make decisions on recruitment.
Mm.
So it's almost like things are getting a bit delayed in the recruitment cycle, and that's what's caused the latest slight downgrade in profit forecasts. But where employment numbers go, it's very difficult to gauge at the moment. Certainly Page and Robert Walters have benefited by people deciding to change job a bit more. Maybe the home working enables people to go to more online interviews and things. So there's been more turnover, more activity in the employment market. People are holding out for better wages and are moving around from job to job. But I can't tell you at the moment, where we're going in terms of this employment cycle. Very difficult to read.
And staying with this cheerful recessionary feel note, at least as of the end of last year, you had a fair few investment platforms among your holdings, names like Hargreaves and AJ Bell. Are you still holding these for now? And, how do you feel about holding them if we do kind of move into a downturn?
Yeah. So again, back to the style. What we're trying to pick is companies that we'd be happy to own for an indefinite period.
Mm.
Long-term compounding businesses with these intangible barriers to competition, high returns on invested capital. Quite often they've got structural growth behind them. And with the platform companies, they've got strong returns, they've got strong distribution networks, they've got high recurring income. They are businesses that have got the structural growth of long-term savings behind them in terms of that long-term growth. But clearly, if stock markets are going to have a more difficult time in the short term, that's going to hit their earnings. That doesn't necessarily worry us. Share prices might come down. When share prices are down, we might add little bits more back into these businesses. We've been buying a few more Hargreaves Lansdown. We bought a bit more Integrafin. So in some ways, a long-term approach, having a downdraft in share prices is good because it allows you to sort of top up again and hopefully rebuild as you then move into the next cycle.
Yeah.
So we're happy to own these businesses. What has been certainly a trend in these companies, and all three of the companies we own, AJ Bell, Integrafin, and Hargreaves Lansdown, is that they are investing more into the businesses. So they're investing more into technology at the moment. So some people would say, oh, well, that's a sign of more competition about you're having to make these investments. Well, maybe that could be the case, but it also could be the case that they are going to come out with even stronger positions from having invested more in technology. The more they can embed their customers into them, the better. Businesses will tend to go through various phases of investment spend, and then there'll be a plateau of spend and then another ramp up at a later stage. We seem to be in a stage at the moment for the platform companies where they are having to do some investment within the business.
And how do you feel about, Hargreaves is always a very topical one for our readers, given many will be both customers and investors, but the questions there are always around whether they can maintain their sort of, I suppose, their market share, that really dominant position they have. And you mentioned kind of tech investment, which seems to be very very kind of future facing, very sensible. But there are areas where perhaps they're more vulnerable, like pricing. You have competitors like Interactive with their flat fee. How what's your kind of mood on that?
Yeah. So, I mean, there's always, and there has been a degree of pricing pressure right across the sector in the last few years. And you've seen people like Integrafin bringing their prices down for their customer base. With Hargreaves, again, there's more price competition about. But we do believe that there is a trade-off in the consumer's mind between necessarily chasing the lowest price versus quality of service, and particularly for those customers with Hargreaves Lansdown, the quality of service is high. They are kind of what we would describe as kind of embedded. So they are often customers who are, they've got the system that they're used to. They've got the customer relationships that they're used to. People are more reluctant to move from business to business than perhaps the stock market thinks they might be. We think the stickiness of the customer base, the lack of churn will play to the benefit of people like AJ Bell or to Hargreaves Lansdown. So we're not overly worried about them suddenly losing loads of customers to competitors. The harder thing might be to try and win fresh new customers. And again, whether it's economic conditions or whether there's a sign of that is difficult to tell. But certainly in the last numbers for Hargreaves Lansdown, the very recent period, the last few months, the amount of net new customer wins has been perhaps lower than what people were hoping for.
On just sticking briefly with Hargreaves, one development that's kind of crossed our desk is them perhaps in some ad hoc cases doing discount deals for kind of higher value customers where they're potentially going to go elsewhere. I mean, is that something you've been aware of? Is that something you've kind of you have view on?
Yeah, so I mean that could well occur, and you see that elsewhere in other wealth management companies where people who have got larger blocks of money will potentially get lower levels of overall fee. That's the kind of competitive element that I said earlier kind of is definitely about. There is elements of fee pressure. So again, it can come down to the operational gearing of businesses. So some businesses like Integrafin can take net new flows all the time, which they are doing, which enables them to be also able to lower fees for their existing customers. So there's sometimes a trade-off. As long as Hargreaves Lansdown can kind of get net new customers, grow their business, and the long-term growth of stock markets and wealth, then they can over time, afford to lower fees for their end clients if the overall business can absorb that with the operational gearing of higher levels of funds under management and higher overall levels of clients. But yeah, there's definitely a bit of fee pressure around, definitely.
And how do you have any views on the kind of what you might call the neo brokers? You've seen really big uptake of names like kind of free trade at least over the earlier pandemic days. Are those kind of businesses perhaps too kind of nascent to even start to tick your boxes? How do you feel?
Yeah, they'd be too nascent for us. I mean, they're certainly not businesses that we would invest in. And I know it's back to the kind of a client relationship, the embedded nature of Hargreaves or AJ Bell's clients. Yes, some of these new businesses will perhaps take new clients or fresh new clients on tradings of stocks, but the big wealth management platforms are providing that kind of long-term wealth service to their customers, and it's much more about buying funds, getting a degree of advice, providing strong customer service, helping them with their tax returns, helping them with their cash management. A much bigger service than just trading in shares.
Yeah. So moving on to a very, very different sector, you hold GSK, so you will have received shares in Haleon when it spun off very recently. I'd like to ask a fun two-pronged question. Are you first of all, are you interested in keeping hold of those shares? And then secondly, how do you feel about the kind of new slimmed down GSK? What are the prospects there?
Yeah. So we have got obviously now both GSK and we've held on to the smaller portion that came out with the Haleon. So the process that what we talked about earlier in terms of distribution networks, intellectual property, work very well for the pharmaceutical Glaxo business that we have. We think it's a company that has got a good pipeline of business. It's got a very strong distribution network around the world, stacks of intellectual property. It's got high returns on invested capital. So it's a company that we're happy to own. Clearly, the recent Zantac news has been not well taken by the stock market. It's actually quite old news, but it's something that the stock market is suddenly lightened onto. But that's always the danger with pharmaceutical companies. There's always a regulatory risk. But at the moment, we're happy to own Glaxo for the long term, just like we own AstraZeneca.
So the legal concerns aren't kind of enough so far to sway you on the investment case?
No. But neither have we rushed out and bought more because the shares have come under pressure. What we tend to do is just kind of stand back a bit, try and absorb the news, think about it carefully, and not be kind of knee-jerk on these things. Sometimes these things will crop up. And we've had it with other businesses where there's a regulatory risks does come through. Sometimes it's not great news. Sometimes it's not as bad as the market fears. So it's best not to rush in and buy more, but quite often it's best not to sell out either. Just calmly reflect is what we tend to do. And then with the spin out, the consumer goods business, again, we've been reviewing it. It's got some strong market positions, but it's early days in terms of our assessment of the business. We want to check out more its returns on invested capital. So there's more work coming through from Quest, the database that we use for that. So we haven't added to our position. We have similar businesses like Unilever and Reckitt. So it's a kind of area that we like as an investment style, distribution networks, brands. But it's time for a little bit more assessment on the company. It's got some nice brand positions, but it's also quite geared as a business. So that would limit how much we want to do own of it.
Yeah. I was going to ask, do you suspect it could become a bid target? I mean, even perhaps for one of your existing positions, like Reckitt and Unilever previously did a bid itself. And how would you feel about that?
I mean, definitely it could do. And again, we tend to, when these things occur, we look at them on their merits, and we'll look at valuation and work out whether we think the price is attractive or not. Clearly, the kind of Zantac news might be something that puts people off for the moment until there's greater clarity on that. But yeah, I mean, Unilever looked at it before, and no doubt people will be looking at it again, picking their moment. Yeah.
And I guess that brings us neatly onto a subject you guys have talked a lot about this year, which is kind of M&A and corporate activity. You've had a fair few of your holdings, from CareTech to Clipper Logistics, attracting buyer interest, and I suppose you've also partly been on the other side of that with names like Next 15 Communications. Fund managers sometimes get fairly, I suppose, hot under the collar at M&A, get very frustrated about a multi-bagger potentially being taken away from them before they can keep that compounding going longer. What is your stance on M&A and this kind of heightened level that we've seen in recent months?
Yeah, I mean, it's kind of mixed, really. It depends on the valuation and what people are trying to buy your business for. So we had a very, an attractive takeout price for Clipper Logistics. Ideagen, CareTech felt pretty reasonable too. Go back a year or so, we felt the takeout price for Agreco was not attractive enough, so we voted against that deal. And then my eyebrows raised the other day as I read in the FT that there's strong demand for a temporary power at the moment, particularly in areas like where there's terrific amounts of heat and disruption to power. And also people are now worrying about whether we might be short of power this winter. So people have been booking up temporary power units. So, when Aggreko was taken over, we said, well, look, it's a reasonably full price, but not really quite good enough, particularly as this is a business that, has got itself back in shape and should be able to compound growth for a good time yet. So we didn't like that deal. But there'll be other deals, as I've said, where the share prices have been that much more attractive. So you have to just look at them on a case-by-case business. What you do have to feel, obviously, is that there are times when the stock market gets overly worried and you do get a dislocation in price. And private equity are very good at coming in and buying businesses on the cheap. Or when the stock market is being overly excited and overly positive about things, private equity are very good at offloading things at that moment too. So I think the stock market could be a bit cleverer about when it deals with private equity.
I suppose the sterling weakness we've seen this year doesn't help either. And then you have more of your kind of overseas bidders swooping in potentially.
Yeah. So, companies that have been buying our businesses out of the fund, quite often been US backed businesses with that dollar strength. Definitely.
Yeah. On that note, how, this is very much, I feel, industry jargon, but I always like to think about the kind of opportunity set for what you're looking at, what you can invest in. How has that shifted this year? I suppose you've had some names taken away from you, which may be slightly bittersweet, but on the other hand, you do delve into areas like FTSE 250 and small caps, and they've taken an absolute battering this year. So, how is that shaping up and where is looking interesting?
Yeah, so the opportunity set has got better because, as you've rightly said, prices have come down. So you're looking at valuations of companies that are, sometimes 30 or 40% cheaper than they were at the start of the year. So as I said earlier, the price has come down, but the earnings have been pretty well intact. So there are companies that we've been buying little bits for as new holdings in special situations, like Team 17 or Focusrite or Midwich. These are sort of businesses that are doing well, but their share prices have come back a long way. There are companies more in the sort of 250 or the kind of the bigger space. We've been adding to companies like Moonpig, where we bought a position. We never bought it at float, and the shares have been came down below their float price, and we've been gradually building our position there. We've been building our position in Future Group. So the environment of lower share prices has been quite good news for us being able to deploy some cash into those companies. And a number of those shares were looking quite expensive back in the autumn of 2021. Then they got hit hard in January and February this year and provided opportunities to be topping up quite nicely. So the opportunity set is bigger at the moment. And there are other small companies, for example, that we could buy for the fund if we wanted to. But at the moment, we've got about 24% of the special sits fund is in small companies, and we target between 20 and 30% in small companies, and that includes AIM companies. So we feel we're kind of about right at the moment, but there's scope if we wanted to increase that position.
I was going to say, would you ever kind of push beyond that range if things were looking particularly compelling?
No. We target to have between 20 and 30% in small caps, so that's FTSE small cap, FTSE fledgling, and AIM companies, and then 40% plus in FTSE 100, leaving 30-40% in the FTSE 250.
As I mentioned earlier, your fund is especially large, one of the largest ones in your peer group, but you still do kind of focus on small caps to an extent. How does that affect the kind of deployment of cash? I'd assume it must take you a bit longer to kind of move in and out of kind of things lower down the market cap spectrum than perhaps when the fund was smaller, now a long time ago.
Yeah. So, definitely when I started Special Sits way back in 2005, the small companies we could buy could be quite small companies. They could be what we would describe as micro-cap companies. Today, the fund is that much bigger. So to get a sensible unit position in that fund now, you need to be a small cap company of a market cap, say, of 500 million to get a sensible, 1% position within the fund, within that company. So that has obviously meant that these small cap companies now are of a bigger scale. It also means that we tend to have more of them. So there's more of a portfolio effect of small companies in special sits than there would have been 10 years ago. That has good things and bad things about it. Clearly, there's less risk if your average unit position in each individual small cap company is smaller. So if it goes wrong, it is less costly to the fund in terms of performance. But on the other side, it does mean that you can't get the kind of 2.5% or 3% position in the small cap company that, if it really compounds well, can add a terrific amount to performance from its individual performance coming through. So you kind of win and lose a bit. The key thing is to try and get that portfolio of really good small caps that you think can do good long-term compounding. And it's a really good source of alpha for the fund. We've got a lot of small cap expertise within our team. We've just expanded the team. Natalie Bell has just joined the team. She'll be doing a lot of work on small cap with Matt, Victoria and Alex. And that small cap expertise within the overall team is hugely valuable to special sits, and over the years has provided a lot of alpha performance. So something that I think we'd really, really benefit from.
I suppose it's interesting, you mentioned you allude there to the fact that you do have other funds that focus more so lower down the market cap spectrum, but they are open-ended, so they have to contend with the kind of inflows and outflows. Would you guys ever be tempted to kind of move into the investment trust space where you can, not worry about that liquidity so much?
Yeah, I mean, it would be nice. It would be no bad thing to have an investment trust, but they're really hard things to either launch, because people don't like putting money in at £1 to see it 90p the next day. And then they're also very difficult things to take over, in a sense. So, getting hold of an investment trust of a meaningful size is always tough. And launching one, as we all know, is tough. So it's a kind of thing that we've looked at from time to time, but nothing on the idea slate at the moment. But investment trusts are quite well suited to our long-term style and to smaller companies as well.
Yeah. And just moving back to your portfolio, I mean, moving way up the market cap spectrum, I suppose one kind of segment of exposure that perhaps has helped you in the rougher points of this year has been positions in BP and also Shell. How would you say they fit in with your whole kind of economic advantage approach? Some people might argue it's much more cyclical, much more. Some people might say it's a declining industry, whereas others will disagree. But what's your case?
Yeah, so the case at our top level, the intellectual capital level to start with, is that these are businesses with very strong distribution networks. So you think of Shell, for example, as the biggest retailing business in the world. It's got the biggest liquid gas distribution network in the world. It's one of the big top 3 energy trading businesses in the world. And the distribution networks are strong, but they're also married up with some strong intellectual property. And stronger intellectual property than the stock market will probably give these companies credit for. But there's lots of deep know-how, and there's lots of patented intellectual property within these businesses. So we think on intellectual capital, they are strong companies. Their returns on invested capital have been more volatile. They are, as you rightly say, much more allied in terms of their profitability to the oil price. So they're much more price takers than most of our businesses within the fund. But they have a cost of capital compared to they have a return on capital, cash flow return on capital compared to their cost of capital, which is much more like a cork. It tends to bob along above or sometimes below their cost of capital. And certainly before COVID, the returns were on a much more improving trend because the capital discipline within these companies was improving. Too much in the past, they'd spent too much on speculative exploration and speculative ideas, and the returns were not as strong as they should have been. But the more this occurred, the new management's mantra has been, no, we need to be much better at capital discipline. And you've seen that right across the industry, the amount that companies have reduced their expenditure on oil exploration, on a general capital expenditure for oil service companies has come back a lot. So the capital discipline is there. You then went into COVID and the oil price collapsed. You then came out of COVID and it started to recover. And then because of the Ukraine war, it's gone through the roof and then come back a bit again. So overall, we would expect the returns of these companies to be improving. And that's what we are clearly seeing in the numbers that are coming through. So we think they're businesses that fit our investment style. They are obviously more of a value-y element within the fund. And we do have companies which are more value within the fund. So we have, companies like TBI Cap, which are clearly not expensive businesses within the fund. In the medium term and the long term, clearly BP and Shell have got to be part of energy transition to succeed. But we think they will be, and we think they'll play a very important part in energy transition because of their distribution clout, their energy trading, their government contacts, their regulatory knowledge, their global spread. There's a lot of things about these businesses that give them the ability to play a very important part in energy transition. And then clearly, the debate has shifted a bit in the last 6 months in that people are much more talking about energy security now. So suddenly, BP and Shell have become much more important in government eyes in terms of providing energy security to nation states. And that has become a much more important area of interest for companies and for governments and investors over the last few months.
Yeah. Definitely a sector to watch for many UK investors. Well, that's really interesting, but I'm afraid that is all we have time for. I will simply say thank you to Anthony for joining us today, and thank you for listening.
Thank you very much.